Welcome back to another episode of the Credit Clubhouse, your one-stop shop for all things credit. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Today's episode features Nicole Byrns, partner at Dumar Capital Partners. Nicole and I discuss the exploding growth that's taking place in ABF, or asset-based finance. We have a refreshing conversation around downside protection and when things maybe go the wrong way or not as good as you thought, data centers, and much, much more. Quick plug before we get into the episode. If you wish to attend any of our conferences, we have a great deal for the listeners. Just go to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT. You'll receive a 15% discount on your ticket. As always, don't forget to follow us, rate the show, and leave a review. Now, without further ado, I present my conversation with Nicole Byrns of Dumar Capital Partners. Welcome to the podcast, Nicole. Good to see you. Thanks for joining me.
Thanks for having me. I'm excited to be here today, Todd.
Well, thank you. I see that you've joined a new firm, Dumar Capital Partners. So I think tell us a little bit about your journey. I know you used to be at a Canadian pension. Tell us a little bit about your journey and maybe a little bit about this new shop.
Yeah, sure. So I have been working in the asset-based finance industry for over 20 years. I've been at banks and asset managers. I've invested up and down the capital stack, for the most, senior investment grade all the way down to the equity and residuals, asset buying and lending. So, I formed Dumar Capital in the last year. It's my own company. And there's a couple of things I'm working on right now. One is, I'm exploring launching my own fund. I feel as though even though there's a lot of interest in asset-based finance, a lot of funds getting into it, I feel as though that I do offer some type of differentiated strategy, given my expertise and my investing through different credit cycles. Mm-hmm. But I've also been providing senior advisory services to specialty finance companies, loan originators, asset managers, and service providers, really for those who are new to the sector and want to find out more about it, find out how to get into it and how to grow a strategy within the sector and also how to manage a business. So that's been actually really exciting because it's, working with, people that are really excited about this industry, but maybe, still need some introductions to it. And so that's really where I can fill the gap for them.
So to widen out a little bit, private credit has clearly been a buzzword and kind of has filtered through a variety of financial markets. Mm-hmm. I know today's going to focus more on ABF, and I'm curious, does ABF offer that best long-term opportunity in your mind? I mean, I know there's a lot of stuff on direct lending. SRT seemingly was popular last year, maybe not as much this year. What are your thoughts on kind of just that broader trend of private credit? And before we kind of jump in a little bit deeper on ABF.
Yeah, so, I'm a little bit biased toward ABF, so I'm always going to say it's the best long-term strategy out of, any type of private credit strategy or even any type of credit strategy personally. I mean, the reasons I've really, stuck with it for the time being, for my career is that I feel as though it offers the most downside protection while still being earning a premium over other credit products, and that's due to the complexity. But when you look at the structures in terms of, you usually have collateral coverage, you usually have mechanisms to, seize cash and pay down. It's an amortizing product. How can that not be good? Especially when you compare it to something like, say, direct lending, where it is sort of a future projections, EBITDA leverage type structure. Where, what's the downside? Maybe you have some equity behind you, maybe you have some junior debt behind you, but, beyond that, that's it. And you're right, SRTs have been very popular, and in fact, they've been popular in Europe for quite a while. Yeah. And it's just really kind of coming to North America that has gotten the interest. And, I think they're going to continue. Even despite the administrative changes that may or may not be happening. And it's, again, it's a way for banks to be more balance sheet efficient. And, I think that's sort of the topic of the day of, banks, what they can and can't do with their balance sheets. So I think that will continue. It's just that SRTs are just, to me, they're another form of structured credit. You're sort of basically, taking some synthetic risk to a pool of assets, financial assets. So it's kind of sort of the same ice cream, but different flavor, I guess. But yeah, so for me, long-term wise, ABF is, provides the most downside protection against, most of these products that are sort of popular today. And then the other thing I say is direct lending, to me, it just seems to be getting very crowded right now. It's so talked about, and there's so many places that are doing it. There's some places that have been doing it, and that's all they've been doing, and there's other places that are now getting into it. And it's just, granted, sort of at that level of the middle market, there's probably an unlimited or infinite number of companies to finance, but at the same time, how much are people going to be competing for deals for the same deal?
Yeah.
So we'll see.
So, to start digging a little bit further on ABF, in part, the reason it's grown is, the regulatory burden increased on banks post GFC. But now you have new administration coming in, which is obviously signaled that it's going to be a friendlier regulatory environment. Mm-hmm. Do you see this? I was reading an article the other day. I think it was a fund manager saying, in the short term, we might see some impact to the ABF market, but long term, we still see this as being the play where we want to be. Do you see an impact there in terms of banks maybe changing their behavior? And how that might impact where some of the private capital is kind of filled in where the banks used to be?
Yeah, I personally, I think that you might see some changes around the fringes there that, maybe some of the activities that banks were thinking about, reorganizing due to, the regulatory changes that were coming through in the last few years. But, personally, again, having worked at banks both pre-GFC and post-GFC, I did see the most fundamental change in the regulatory framework around that time, really in addressing, what happened during the financial crisis. And some of those are, changes that are there and always going to be there. And I think they're also made our banking system a lot stronger and a lot sounder. So the bank structural changes that happened post GFC, that gave rise to that whole fintech wave that came up in the mid-teens. And so what you saw is this, bank regulatory framework creating a lot of financial innovation and a lot of new development in that marketplace. And it also created a whole new investor base. And subsequently the ABS market, followed with sort of securitizing a lot of these new technologies. So I think that's actually one of the interesting things that you see out of the bank regulation. It's not necessarily a bad thing, because in my experience in asset-based finance, whenever there's a regulatory change that affected our market, we always found some innovative product to sort of not get around it, because you definitely don't want to usurp what's being done, but to just find more efficient ways to operate within this new framework. So I think that's actually kind of exciting in this marketplace. And, you see that SRT market sort of in the U.S., kind of growing and, as a result of some of the changes, and, it's creating a lot of innovation and new products out there. But the one thing, though, that I am kind of curious about, especially with the changes in the CFPB, is are we going to see more of these high APR consumer finance products coming back, which I personally don't think is necessarily a great thing. Unfortunately, I don't want to offend any of the listeners here, but I think some of those products really were not maybe had the best intentions in mind. And so the question, and to be fair, a lot of institutional capital providers these days are prohibited from working in some of those high APR products, but not all, but some. So the question is what's going to happen with that market with some of the regulatory changes that are happening now.
And just to pick up on that, I mean, not obviously some institutional investors can't play in that space, but the ones that do, and if they're searching for extra yield somewhere, does it end up giving a rise to payday or high interest lending, maybe as a byproduct of, hey, I can't get it somewhere else in the market with a plain vanilla consumer loan from one of the top lenders, but I can get extra. Yeah, the risk is higher, but over the long term, I'm probably going to make more money on my money. Is that, obviously it's a concern for you. Does the CFPB either losing power or going away? Do you see something filling that void?
I don't know. I mean, the state, local jurisdictions actually have been regulating those spaces quite a bit. The thing is, you can kind of go state shopping. Some states regulate it more than others. So you might see some lenders kind of going to certain regions over others. But the question is, what's going to be the capital that is going to be funding these businesses? How expensive is that capital going to be? So it kind of feeds into each other. They might be getting expensive capital, and hence the products need to be expensive unto themselves. What the interesting thing is, there's a lot more places for a consumer to go for financing right now, no matter where you're on the credit spectrum. So it's also wondering if, there's probably always going to be a demand for those high APR products like the payday lending and things like that. But the question is that market just shrinking because there's so many other places that people can go to now. So I don't know. It's time to tale to be seen.
Before we jump into maybe some specific asset classes and other things within the ABF market, I did want to ask about the terminology, because we've obviously been using ABF on this episode, but in many places it's called specialty finance or fintech lending, esoteric asset classes. Yeah. I mean, to me, it feels like we're all talking about the same thing, but depending on where you sit in the market, you might not think you're in ABF, but you're in specialty lending. I mean, do you see that kind of melding over time in ABF becoming kind of the dominant term?
It is so confusing. All these different terms, so confusing. I just wish that people would just sort of settle on something. I used to call it structured credit or even structured finance. And then now people are talking about asset-based finance. And from what I've seen, the market tends to be calling asset-based finance like private structured credit, but then does that include the capital markets, transactions also? Yeah. It's very confusing. And then also asset-based finance is not asset-based lending, and people confuse those terms too a lot. They're similar, but very different. So it's so confusing. And then you also have the groups like specialty finance, as you sort of said, or capital solutions or capital structuring or structuring capital. It's really, really confusing. And I think honestly what you need to do is when you see a term that's not asset-based finance or something, you gotta have to sort of read through and this is what I do, I read through sort of the details to find out, what are they really talking about? And I found the same thing with private credit, because people have been throwing around that term quite a bit. And sometimes they talk about direct lending being private credit, but everyone has their own definitions of kind of those. To me, they're not the same. So it's really, really confusing. But I don't know. But like I said, the market seems to be more and more focusing on asset-based finance as the private side of a structured credit business.
So jumping a bit more into kind of specifics around ABF today, and curious, what asset classes do you think are most exciting in the market today?
Well, I mean, I think they all are. So, however, to me, the market is kind of falling into a few different segments, and it also seems as though once some asset classes start accessing the capital markets, they are less new. And, given that, because, once you sort of access the capital markets, you've probably been operating the private markets for a while. So you have a whole host of characters now who are used to that asset class. But getting back to the segments, I would say the more traditional asset classes like auto loans and credit cards and equipment leases, they, are all regular, financiers in the asset-based finance market, the capital markets. And so they've been really sticking to the, bank warehouse, ABS takeout market for their financing, and not tapping the private markets as much as you would think. They might do it here and there. A lot of times they might do it to either fund a new strategy or new product, but you're not really seeing them kind of, doing sort of the more expensive financing when they can get cheaper financing elsewhere. But then we also have kind of like those esoterics, which aren't really esoteric anymore. And I would consider that say residential solar, even data center. I mean, data center has been financed forever, for a long, long time. They just recently started coming to the ABS markets, and honestly, I don't know why it took them so long to get there, because it's a pool of contractual cash flows. How could this not be securitized? I don't know why it took them so long. But even you also have sort of the non-traditional mortgage products like non-QM and SFR. Again, people call them esoteric or new, and they're not. They access the ABS capital markets fairly efficiently.
Is that kind of where you draw the line between esoteric and not, is when they kind of get to the capital markets, where it's like, all right, we're private for quite some time, we've matured a little bit, now we can access securitization and capital market products. So is that that's where the line draws from esoteric to not, at least in your mind?
Yeah, that's what I would call it. And I mean, I think, like they said, the market kind of has that traditional bucket, and then everything that's not traditional is in esoterics. And yeah, to me, esoterics, when I pay attention to the private market, I really do pay attention what are the esoteric ABS issuances, just because that's kind of where the private market is sort of percolating, and then they sort of will, they don't necessarily exit, they still will hang around those sort of newer asset classes, but that's kind of where they'll sort of hover for a while until that asset class is ready to be securitized. And what determines the securitization is really, does it have the volume to access the markets, and does it honestly have rating agency support in terms of being able to rate the bonds? So those are a lot of sort of things you need to put in place in order to sort of build up an ABS business, which then kind of gives you to become more mainstream. But then there's a few asset classes that haven't hit the capital markets yet, and which they're kind of new. I wouldn't say they're super new, but for example, there's a lot of exciting things being done in the IP market these days, and I'm not just talking about music. I call that esoteric market that we just talked about, but all the other IP stuff, that's kind of interesting. The one thing about some of these IP deals is that you really do need subject matter expertise. It's really, you think you can kind of go into it thinking, oh, I know how a film, distribution rights, how that works. No, you really don't. And you really do need to have somebody who knows that business and can kind of walk you through it. So it does require some partnerships. And then there's always the fintechs who are coming up with new, they're taking traditional products, like say auto loans, but they're originating them in different manners or structuring the risk in a different way, which I actually find really exciting. And that I do find is sort of kind of the newer products, or the newer asset classes that are quite exciting.
So I wanted to touch a little bit on data centers. I see constant stream of news and data centers. All the big funds, Apollos of the world are clearly jumping in. I mean, is that one of these asset classes? You just said, obviously, they've now reached the capital markets, or at least deals are coming to capital markets. I mean, is that one of the areas that in the next 5 years, we're just going to see this explosion of exponential growth?
It's curious to see. I mean, definitely seeing a lot of growth right now in that market. And I think what's interesting is, there's such a demand for technology, for AI, server use, that people feel that's going to be creating the volume for it down the road. And also with data centers, you just don't build them in a day and they're operational the next day. There is also a long lead time to get them operational to the capacity that you need them to be at. So it's, between this sort of growth that people don't see it ending ever, that need for capacity, and then also that long lead time. I think you're going to have a long runway of financing opportunities in those sectors. The question is, will there be in 10 years, 15 years, another new technology that comes up that makes the need for all these hyperscale, data centers necessary? Nobody can see it right now, but who knows? Technology has, disrupted a lot of these industries. Look at music, 20 years ago versus now.
Is there also a regulatory potential issue for data centers? Like, I've been reading, there could be bills to address environmental concerns around the power usage and what that might cause to then the build out of some of these data centers, how they're done, how they're powered.
Yeah.
So you obviously started off saying the downside risk in terms of a lot of these transactions. It makes ABF appealing. Does that also put a risk factor on data centers somewhere?
Oh yeah, totally. I mean, it's a little bit of factoid about my personal life is my husband's father actually owned a data center in New Zealand.
Wow.
And yeah, so it's really interesting, seeing it operationally, day by day. And his number one concern was cooling. And how do you produce air conditioning? It's by power.
Interesting.
And, you just needed to make sure that you always had a guaranteed power source into that data center. Now, the question is, with some of these large data centers that are being built today, you need basically a whole, power plant next to it in order to generate the amount of power that these places need. So it's not like you can kind of get a solar a couple solar panels and make it work. It's just massive amounts of power that they need. So, the question is, does our energy infrastructure in the country have enough capacity to handle this demand? I think it's really the need.
Does that open up a whole new asset class of powering data centers?
I think so, yeah. I think so.
Wow.
I definitely think so, yeah. I mean, there's a whole power trading market in which what my husband does actually, and trying to generate power and getting from point A to point B, and then also kind of managing the risk along the pricing risk and along that line. And so the question is, how are those markets going to develop or expand in order to meet all this need? And what's interesting is the data center needs it's very sort of geographically specific. It's in one certain area as opposed to sort of you need a whole transmission line or a whole generation for Texas. It's like one little area. So I think it's an interesting market because it's kind of real estate, technology. As you sort of said, it has that asset-based finance component of contractual cash flows to the tenants. There's a lot of barriers to entry, but then people look at what's the stickiness of these assets. So there's a lot of different interesting aspects to data centers that I find super, super interesting.
Yeah, ABS deals are clearly hitting record levels. Someone that's been in the space a while, like yourself, is there a concern that history could eventually repeat itself? Is there just so much more guardrails in the system today with obviously the banks and, history's not that far in the past that, the record levels aren't necessarily that big of a concern and credit quality is not like going down to, bottom basement levels like it might have done back in the mortgage days. And maybe some of the asset classes might be a bit more spread out and less concentrated than the mortgage market was.
Yeah, I think you guys have to look at sort of both sides. Yes, things are great. Market's growing, and there's definitely both a supply and demand in terms of supply of assets to finance and investors that are willing to put capital. So that's great. There are a lot of guardrails that were put into the sector post GFC, and I think personally they were all for the better in terms of say risk retention and disclosures, rating agency roles now. Information transparency. So I think those are all good, and I think the market has accepted them and it's learned to live with them, honestly. And I don't really hear anybody saying, "Oh, I want risk retention to go away." So I think those are good. The question is that the one concern I have these days with this growth is that you look at some of the pricing on the bonds in recent months, and the pricing, the spreads have been so tightened that are they really accurately pricing the risk, or are they pricing according to their cost of capital? And it's the latter that gets me concerned in that, especially if you have people who are pricing just to get market share or pricing because they think they know the risk but don't, and then they get into trouble, then that's where they're going to find themselves upside down. And that gives me a little bit concerned because you could potentially have a few big players who operate this way and that disrupt the market when they can't participate in the market anymore. So that's really my main concern these days is what's the risk that people are taking, and also some people are pricing the risk with the leverage component on top of it, or sort of factored into it. And that's concerning too when it gets to be over levered, which, I think the market was, extremely over levered pre-GFC. It's a little bit less over levered now. But again, with all these products of say, asset level leverage you can do and a fund level leverage that you can do. Then also some originators will do sort of recourse financing on, the residuals. When you get into sort of this highly levered market where it's hidden leverage because it's leverage on leverage through various layers that people don't look through, that's really where things could also get tricky. That chain breaks, honestly, and people kind of realize that there was a weak chain and that weak link in that chain, but you don't see it until it's too late.
Well, speaking of the weak link in the chain, you had recently put out an article on LinkedIn I thought was interesting, talking about, kind of some of the bad outcomes. I think it was titled Defaults, Failures, and Lessons Learned. I mean, should we be talking about some of that in a bit more of an open forum? It always seems like we talk about bad outcomes after the bad outcome. And then it's like, all right, how could we learn from what happened? But if you're talking about some of these outcomes more, more frequently, do you kind of catch some things prior to them happening, which is, I'm sure, some of the motivation, but behind putting that piece out?
Yeah, I mean, don't they say hindsight is always 20/20 or expression? Yeah. And honestly, that's what gives sort of some of the more tenured people in this space, like myself, so a little bit of hindsight and be like, well, this exact same situation happened to me back in 2005, and that went bad, so I know not to do that again.
Yeah.
So we can kind of sort of sit there and restructure. But I loved writing that article because I look back fondly on those experiences, even though they were extremely nerve-wracking at the time. And I loved hearing, I did a lot of research also with some colleagues, hearing their war stories, and that was really interesting. And we would be on the phone forever, like, remember this, and that guy on the phone. And it was a lot of fun sort of writing that article. But I think also one reason that I, brought up that topic is because there's so many white papers out there produced by all these different parties, agencies, managers, everybody's producing a white paper on asset-based finance. Nobody's ever talking about, what happens when things go wrong. It's as if like it never existed, as if nothing bad ever happens. And no, things do happen. And I really do think people kind of need to sort of go into things because it's not necessarily, yes, your underwriting is really important and your pricing of the risk is really, really important in terms of to minimize the downside, but it really is also your deal structure is so critical. And you need to think about, can the structure protect me in an adverse situation? What are the mechanisms that need to sort of be put into place and enacted upon in order for this structure to work? And I just don't think people really think about that too much. And I think also you're finding a lot of people now who haven't gone through that credit cycle yet and haven't tested these structures personally, directly. And so for them, it's all just theoretical, like I'll call a rapid AM event and everything will be good. No, I've called rapid AM events and my cash is sitting in a whole nother place that I didn't know about. So it's not good. There's no cash to collect.
Do you think in times like we're in now, which, we just talked about ABS deals hitting record levels, that some of those protections and some of those structural things that you might be more careful to dot every I and cross every T on, that there's so much capital in the market, so much enthusiasm that some of that stuff doesn't get put in deals. And then all of a sudden you start having these issues when all you had to do was think, all right, let's just put these things in place just in case. Because even though times are good, and that's what seemingly starts it, where it's like, it bleeds a little bit. A new manager comes in. I have to do this. I'm going to win the deal because I'm going to do less downside protection. And all of a sudden, it's like deal after deal after deal is structured without as much protection. Yeah,
I think that is definitely a risk. Just being, people just really trying to, get market share by, do you want to call it covenant light? I mean, that's sort of more direct lending, but, will we become sort of a structure light, I guess, is someone can call it for our business. But I think what could potentially be one of the things that could happen in the market is that it's really right now an originator's market. There's a lot of capital providers, and I've talked to several loan originators, and they get multiple term sheets for financing from multiple parties. So the question is, can they now start playing off these different capital providers in terms of not only price, but now structure to give them more flexibility to operate their business. Now, as a capital provider, I want to give my counterparties flexibility to operate, but I don't want to do it such that I really expose myself to inherent risk when things don't go as I expected to it. So, I think the market has a little bit of discipline from what I've seen and people I've worked with that, there are certain things that people will not give on and will just walk away from the deal. But on both sides, honestly, both the originator and the capital provider, where they'll just walk away where they just can't, meet in the middle for what the other party needs. And I think that discipline needs to continue. Again, it's really has to do with the those who are just very, very anxious or feel as though they have to be in this market, and those are the ones who are sort of going to go after market share. But I think those players will sort of kind of be very apparent fairly quickly. The one thing, though, that I want to distinguish between is, those deals that really go upside down, you have to sort of enact your structure and make sure and give yourself, start putting in place the protections that are in the structure. But there, we always have, everybody has a deal that goes like, meh, not really quite as well as you expected. Maybe performance isn't as good. Maybe the structure wasn't quite as tight. So you still were sort of somewhat protected, but it just didn't hit the returns you needed. Like, that's not what I'm talking about. Like, we've all experienced those types of deals. Yeah. And those deals will always exist in the marketplace. So, I think people do need to differentiate, those like so-so deals that didn't go quite as well versus like the true default, or sort of adverse, downside situation.
So you've recently, in addition to your credit check newsletter, you've also started a Balancing the Books newsletter, and talking about women in markets. And I'd be curious to hear your response to, if you were able to give someone advice that was just leaving college and she's looking at financial markets as a potential place to go. You've have plenty of experience working in banks and funds, and curious kind of what that advice might be.
I think personally, first off, I love writing those articles because I've had a lot of those article ideas have come out from some very good female colleagues I have in this, or very good friends who are female colleagues in this field, and we just sort of sit there and vent around the coffee table about all these things. And like, finally, I can kind of put it out there, and it kind of explain what sort of a lot of the women have been talking about, what we're frustrated about. So that's been really actually very refreshing. I do think there's these articles so far, and there's still a lot more in the pipeline that I need to do, is, I try to address different things that people have. Like, there's no one career that has the same type of concerns or pitfalls or challenges or successes as others. So what I do is I ask people to take what they want from the articles that they need. For me personally, sponsorship was something, if somebody told me about that way back when, to make sure you have a sponsor or sponsors wherever you are in your career, in your industry, I think that would have made a big difference in my career. I would have made things probably a lot easier at certain points in my career. And so, people are so focused on the mentor. I need a mentor. And I'm like, that's not necessary. Like, we all have mentors, but what you really do need is that person pounding the table. And what I found for me is that I have great sponsorship among my female colleagues. There's not a single one of them I know who would not pound the table for me in that meeting room. But it's just how to sort of translate that sponsorship over to, the men in the room, who are generally the ones making the decision. So that's something that I still am, looking at today and trying to figure out how to kind of break that barrier just for everybody. So it just means a lot of people kind of need to start chipping away at that ice cube to have it break. But in general, like, I love writing these articles for both newsletters. Please, I hope everybody subscribes to them and likes them and reposts them, because I love hearing people's reactions to it. Sometimes I get, private messages from people, and sometimes I get, public. And so it's been really interesting to hear everybody's reaction. And the only thing I can say is I just wish I had more time to write these articles, because there's just been they've just been probably the most fun thing I've done, in my sort of new company.
Well, I've read every single one of them, so I hope
you.
that you keep it up.
Yeah.
They give me some good ideas and some good reading as well. So I like to end the episodes with a bit of a lighter touch as we head out the door. So do you have a favorite sports team or hobby?
So I am in absolutely no possible way a sports person. Okay, let me put that out front there. But I actually am a little curious or a little bit excited about March Madness coming up. Curious to see about the Duke team, how they do, and also about St. John's, which New York has adopted as their team. And I think
it's been a long time since St. John's was in this position.
Exactly, or anybody sort of from this area. So it's exciting. And the one thing though that I was reading a story about it today is what's good and bad about March Madness. It's not necessarily like the best team gets to the finals. Like it's a in or out type situation. So you could just have a bad day and you're out of the whole tournament. Yep. That's what I find really exciting about these games. You can find some really amazing games, and really it's the only time of the year I watch college basketball. And then the other thing is that people who know me, I am a extremely obsessed skier. It's all I sort of think about and do about and talk about in the winter. And we're coming to the end of that, so I need to find something else to do. But my son is a very active ski cross racer. So if anybody knows about ski cross racing, it's where the 4 people go down the course at the same time. There's jumps and
Oh, okay. Yeah, I've seen it.
Yeah, it's amazing to watch, and so I just really want to give a plug for that sport because it's just so much fun to watch. It's a little scary, honestly, once your own son up there, but you sort of distance yourself from that aspect. It's really quite exciting. I call it the roller derby of skiing. So.
Tell us one surprising thing about yourself.
I don't really have too many surprising things. So I think people know a lot about me. The one thing that's really exciting is, I got a dog in the last few years, as everybody else did. And we are now going to start, I think it's therapy dog training at a local hospital. So we're going to be visiting children in a local hospital. So I'm really excited about that. Just to sort of, my dog is, as most dogs are, like 100% pure happiness and joy. And so just kind of sharing some of that happiness and joy to people who kind of need a little bit of support.
And then final question is one prediction for the next 12 months.
I have absolutely no predictions, honestly, for 12 months. Everything changed. I have no idea. Things are changing so rapidly across so many different aspects of the world, whether government or national, financial, personal, whatever. There's, everything. Something that I think is going to happen next week just totally changes. So I'm just going to stay silent on this one and see how everything plays out.
Well, Nicole, I really appreciate you spending a few minutes with me. It's nice to see you again, and I look forward to seeing you again sometime in the future.
Great. Thank you so much, Todd. I had a lot of fun.
Yeah, thank you.